Hello friends, how are you? I hope all of you are doing really good. So welcome you all to the EFF Excellency Batch, that is Economics for Finance Excellency Batch. I hope all of you are enjoying it, and if you are enjoying it, do hit the like button on the video and share with all your friends. If you are new to the channel, please do not forget to subscribe to the channel, because this is the only channel where you're getting the full regular courses on YouTube and overall the quality education at the most affordable prices. Okay, so all those who want the handbooks, they can buy it from our website. The website link is flashing on your screen at the bottom, www.ksjteaching.org. So what we have been discussing about is, we have been discussing about national income, and we were discussing about the various components of the national income. The various things we have discussed in the last lecture. We discussed about factor cost, market price, what are indirect taxes. So all these things we have discussed in the last lecture. So what I'm going to do is, in this lecture we are going to have a quick recap of the components that we have covered. Why I'm giving you this quick recap? Because I'm going to link it with the further topics, and this is an important part from the practical point of view also, right? Which is one of the most scoring parts in the economics for finance, right? So let's have a quick recap of what we have done regarding the components of national income, right? Components of national income. And I'm going to discuss a few things also. During this recap only, we are going to discuss a few things, okay? Components of national income. So what is the first component that we have discussed? What is the first component that we have discussed? The first component that we have discussed here is GDP at MP, right? That is gross domestic product at market price. So what does it say? The gross domestic product and market price says it is the market price of all the economic goods and services produced within the domestic territory of a country, whether produced by the nationals or whether produced by anyone from outside our territory. If the production is taking place within our territory, it is to be included in the GDP of our country, right? Clear? So what is GDP at MP? It is the value of output. It is the value of output, right? This output is within the domestic territory of a country minus the value of intermediate consumption. Value of intermediate consumption. This we have already discussed why we are subtracting this intermediate consumption, right? This revision is very important, because what I'm writing is going to be with you for a longer period of time, right? You will remember this thing that yes, sir has written something like that, right? So while doing the practical problems also, we can refer these things, okay? Okay, so what is value of output minus the value of intermediate consumption? Now here tell me, if I talk about the value of output, how will you identify what is the value of output? Value of output means the market value of the goods. Now if I talk about the value of output, what is value of output? What I mean by value of output, this thing. This is the market value. This is the market value of output. Market value of goods and services, right? What is market value, sir? That what is the final value in the making of that good plus whatever the taxes are there, whatever the profit is there. So what we say, how do you identify the market value? Can you tell me? That will be cost plus profit plus what? Taxes, would call it as indirect taxes like the GST and all, right? Indirect taxes minus if there are any subsidies, right? Now what can be in the form of cost? What can you take it for the cost, sir? What can be there for cost? If we talk about this cost element, what is there in the cost? You can pay the rent for that, right? Rent is there, then labor is there, then interest cost on capital. You are using the money that we have studied about. Interest is there. So if I combine all these things, what is that? If I combine all these things, what is that? This is my factors of production, right? This is my factors of production plus the indirect taxes, factors of production plus net indirect taxes, plus net indirect taxes. Clear? So how do you find out the market value of goods and services? It is cost plus profit plus taxes minus if there are any subsidies that you are going to receive it from the government. How do you find the cost? Cost is rent plus labor, interest, any of such things which you are paying plus the profit. So we call it as the factors of production: land, labor, capital, entrepreneurship, right? This profit is what? If you call this profit, what is this profit? So profit is nothing but your entrepreneurship, right? So this combinedly makes my factors of production plus the indirect taxes, that is combined my GDP at MP. We also call it as what we call GDP at MP. We can also call it as sum total of value addition, right? Value added. So this is the concept clear. GDP at MP is equal to value of output minus value of intermediate consumption, or sum of value added as we call it, right? Then the next concept that we discussed, was GDP, sorry, not GDP, GDP we have already done here. That was GNP at MP. Now what is that? We are going from domestic to national now. From domestic to national. What do you have to do for domestic to national? You will take it as domestic, whatever is manufactured within the domestic, plus if there is any income from abroad, which we call it as net factor income from abroad, NFIA, right? This is your net factor income. Net factor income from abroad, right? If an Indian national is earning some income abroad, he brings that income back to India. That is what? NFIA. Minus, okay, this is net factor income. If an Indian national, he is residing outside, he is earning outside, he is bringing that money back to India, that is factor income from abroad. If a foreign national comes to India, he earns here, he takes money back to his particular country, let's say USA, that is factor income to abroad. And the net effect of that, we take it as net factor income from abroad. We have studied in the very first lecture, FIFA and FITA. Clear? So this is how you convert it from domestic to national, right? Always remember this. Now, the third concept, this is GDP at MP, this is GNP at MP. Now, third is NDP at MP. What is NDP at MP? That you are going from gross to net. So this is GDP at MP minus depreciation. So here, when we are talking about GDP at MP, if you look at the various costs, here you will be having the depreciation also, sir, because this is inclusive of depreciation. If you're taking a separate cost, rent is there, labor is there, interest is there, depreciation is also a part of the cost. And when you are calculating the net value, you remove that depreciation from the gross concept to get the net value. Clear? So this is GDP at MP minus depreciation. That will give you NDP at MP. The next one that we have done is fourth, that is NNP at MP. NNP at MP. What is NNP at MP? Now you want to go from domestic to national. That is NDP at MP plus NFIA, right? Or it can be written as, if you break this NDP at MP, I can also write it as GDP at MP minus depreciation plus NFIA, right? So it will depend upon the information that is available to you in the question. That accordingly you have to calculate it. We'll be doing the practical problems. We'll be following the ICAI module practical problems here. So from there you will get a better judgment that how you can calculate it, right? So I'm giving you a fair idea about what are all the formulas that is available with us, right? NDP at MP, GDP at MP minus depreciation, and NNP at MP is equal to NDP at MP plus NFIA. Or if you break NDP at MP, that is GDP at MP minus depreciation plus NFIA. Clear? Any doubts? Any doubts, sir, in this part? I hope this much is clear to you, right? or this can be written in another way also, sir. This can be written in another way also. If you talk about NNP at MP, if we want to calculate it from GNP at MP, if you have GNP at MP, right, you want to go from gross to net, you will simply subtract the depreciation from here. That's it. So these are the various ways in which you can do it. As I told you that this will depend upon the information that is available to you in the question, right? Simple. We'll do the practical part. It will be more clear to you. Okay. So this is what we have done. And one thing more we discussed, that when we are talking about the market price, the next thing that we discussed was that when we are talking about the market price, what is market price? Market price, I told you that whatever is the value of output, right, plus we can say the cost plus profit plus net indirect taxes, plus net indirect taxes, right? This is what is there. What is net indirect taxes? This is indirect taxes minus subsidies. Indirect taxes minus subsidies, right? So this is my factors of production. This is my factors of production. Now try to understand one thing very carefully, which we are going to use it now. Now, if I say that I don't want to take this part, then what will be there? If I consider only this part for the valuation, will it be my market price? No, sir, that will not be my market price. Only this part constitutes my factor price, right? This is known as factor price or factor value. Market price is factor price plus indirect taxes, and if you want to take only and only the factor price, then what is there? Market price minus the net indirect taxes. What is the role of factor price, sir? Why do you calculate the factor value or the factor price as we call it? Sir, it is important because this is the money which is going to be in the circulation in economy. Indirect taxes or the taxes will go to the government. That is on one side. That is the market price, right? The factor price is you manufacture a product, you pay to let's say a laborer, right? You pay wages to a laborer. That laborer will spend on buying some goods that will again be the money in the circulation, right? Again, that good will be manufactured. Someone will be paying to the laborer. The laborer will spend the money on buying a good, and the circulation so on goes out, right? So he says that if you really want to identify that how the economy is performing, if you really want to identify the performance of an economy, then you should focus more on this factor value and not the market price, because the indirect taxes, the net indirect taxes, is not the real indicator of the performance of the economy. So if you really want to know what is the level of demand of goods and services, how the economy is performing, you have to focus on the factor price, right? What is your factor price? How you are manufacturing, whether people are ready to pay for that price or not. Indirect taxes, that is a separate issue. That is a fixed part that will go to the government. That is absolutely separate thing, right? So he says whenever you are you want to calculate, you want to identify that how our economy is performing, and that's what is the main role of national income. The national income significance we have studied, that says you need to identify that how the economy is performing, whether there is demand for goods and services in the economy or not. And how will you identify it? For that, he says, do not take market price. Take what? Take the factor value, take the factor price, right? So let's see what he has to say now. Now we'll come back to the books. Open your books now. The next concept is gross domestic product at factor cost. This is known as factor cost. Now, again, three things we are going to highlight. The first thing is gross, the second thing is domestic, and the third thing is factor cost. So all these three things combined, what? Gross means that depreciation is not to be subtracted. Domestic means that anything which is being manufactured within the domestic territory of a country, and the factor cost means the market price minus what? The net indirect taxes. So it is the value of all economic goods and services produced within the domestic territory of a country, whether by residents or by non-residents, that we understand, right? The valuation of the goods and services is done on the basis of factor cost and not market price. So valuation is done on the basis of factor cost. That is what I told you. That is why I made the whole scenario. I made you revise the things because I wanted to link that with this topic. Clear? So what is GDP at FC? Compensation of employees plus operating surplus. Operating surplus is rent plus interest plus profit. That is from the operations, what is the surplus that you are going to have? Operating surplus is always mentioned as rent plus interest plus profit. Remember this part. This is going to be used in the practical thing, right? Compensation of employees, if you are paying anything to your employees, plus the mixed income of the self-employed. If you are a self-employed, then some notional income can be there, plus depreciation. Obviously, depreciation is a part of gross concept, right? Sir, what about taxes? Are we going to take the taxes? No, sir. We are not going to take the taxes, right? Operating surplus is that the person who is earning this part, he might be earning the rent also, right? Interest also, profit also. This can be the cost part also and the income part also, right? So income, he is paying rent, rent becomes somebody's income. He's paying interest, interest becomes somebody's income. Profit, he is earning profit, that is his income. So that is from the operations, whatever you are earning, right? What is the earning that is flowing in the economy overall? Clear? So after this, he says GDP at FC can be calculated as GDP at MP minus indirect taxes plus subsidies, or combine this. What is this? This is our net indirect taxes. Net indirect taxes. Clear? We have studied in the last lecture also. Here also we say market price is what? The cost of factors of production plus net indirect taxes. So if you want to calculate the cost of factors of production, you will say market price minus net indirect taxes. So this is what is done here. GDP at MP, that is market price minus the net indirect taxes. Clear? Minus the net indirect taxes. Okay, after that, let's move on to the next concept, that is the net domestic product at factor cost. Right? And now it is easy. You are calculating the GDP. Now from GDP, you have to go to the net concept. You simply GDP at FC minus depreciation. Now you can open it up. If GDP at FC is not there, you can take NDP at FC. How you can calculate? NDP at MP. Right? NDP at MP we have calculated minus the net indirect taxes. This is what? This is your net indirect taxes. So it can be calculated in the various ways. After that, net NDP at FC can be compensation of employees plus operating surplus plus mixed income of self-employed. Here you do not have to take the depreciation only. That's it. Clear? So this is the concept, net domestic product at factor cost, where you have excluded the depreciation also and where you are taking the factor cost within the domestic territory. Now, the net national income, most important part, he says net national product at factor cost, NNP at FC, which is also known as national income. So national income is any income which is being manufactured from the goods and services. Okay, any income which is coming from the manufacturing of goods and services within the domestic territory, plus any income which is flowing from outside, everything is to be included in the national income, excluding the depreciation part and excluding our net indirect taxes. So this is national income, the most important part for which we have been studying all this thing. He says it is the value of all economic goods and services produced within the domestic territory of a country, whether by residents or non-residents, valued at factor cost. This part is GDP at FC. Less depreciation becomes NDP at FC. Add net factor income from abroad becomes NNP at FC. This part is GDP at FC, right? Add this part, this will become your what? NDP at FC. Add national income from abroad, this will become your NNP at FC. We can also define national income as the sum of domestic factor income plus net factor income from abroad. Right? So NNP at FC is equal to NDP at FC plus NFIA, or NNP at FC is factor income earned in the domestic territory plus NFIA. Simple. Clear? Any doubts in this thing? Any doubts in this thing? national income, very important concept. All these things are important from the practical point of view also. Very, very, very important from practical point of view, right? That is why I made you revise the concepts first. Okay, so this was all about the national income. All the components we have done now, right? All the components. Which are the components? Let's quickly go through once again what all components we have done. So up till here we have done GDP at MP, GNP at MP, NDP at MP, and NNP at MP. After this, what we have done, three concepts we have done in this lecture. The fifth one is GDP at factor cost, right? Then we have done NDP at factor cost, and then we have done NNP at factor cost, right? Which is also known as national income. This is also known as national income. Clear? So these are all the concepts of national income, components of national income, concepts of national income, whatever you may call it. Clear? I hope this is absolutely clear to you people. This is very important, guys. This is very, very, very important part. Okay. Okay, so let's move on to the next small topics that we have, and in the next lecture we will be doing the practical part of it. So there is a small topic that is per capita income. What is a per capita income? They say there is a particular area, right? In that area there are a lot of people who are there, right? There are many people who are residing in that area. Now I want to see that what is the standard of living of this particular area. So what is that? He says calculate the average income, earned per person in this area, earned per person in this particular area. What is the average income? Let's say he is earning 100 rupees, he is earning 200 rupees, he is earning 1000 rupees, he is earning 5000 rupees, he is earning let's say 3000 rupees, he is earning 1500 rupees, he is earning 4000 rupees, he is earning 10,000 rupees. So they say what you have to do, you have to take the sum total of all the earnings divided by the population. You have to take the simple average. You have to take the simple average of the income to calculate what is the income being earned, average income being earned by a person. Because what is the purpose of calculating this per capita income? That in a particular area, it can be a whole country. We calculate the per capita income of whole country by adding up what is the income being earned by all the sectors divided by what is the total population, right? That shows that how your economy is performing, whether there is demand for goods and services, what is the standard of living of the people. So it is important from that perspective. Sorry guys, the screen, I forgot to change the screen. So this is okay. This is there, right? This is what I have discussed. I'll explain it again. Sorry, earlier the revision part was there, that was showing on your screen. So this is what I say, per capita income. I hope all of you must be having the book, so that won't be an issue. Okay, so I'm saying that this is a particular area and there are a number of people who are residing in the area, right? They are earning different levels of income, but per capita income says you have to calculate the average income being earned by a person in that area. So per capita income measures the average income earned per person in a given area. It can be a city, it can be a region, it can be a country in a specified period, right? GDP per capita is a measure of country's economic output per person. Why GDP at per capita means? Sir, according to the income, we can identify what is the level of demand in the market, right? According to the demand, the goods will be manufactured, right? Economic output per person. If a person is earning 100 rupees, is he in a position to spend 500 rupees? No, sir, right? So economic output will be according to that. The output, the manufacturing will be according to 100 rupees. But if this GDP per capita is 500 rupees, that means that person is able to spend 500 rupees, right? That is the average income that he is earning. He is able to spend 500 rupees. So output will be according to that. Clear? It is calculating by dividing the area's total income or the country's gross domestic product adjusted by inflation. How will you do that? He says, what is the total income? Income is GDP. Whatever you are manufacturing, you will be selling it. That will be a income, right? Or whatever will be manufactured, the factors of production will be paid a part of it. That will also be a income. So gross domestic product, whatever you are manufacturing, whatever you are doing, Obviously adjusted for inflation is there, because you have to make adjustments for inflation. You pay today, that person might be spending after 6 months, that person might be spending that money after 6 months, and after 6 months the inflation will be different, right? So you have to adjust for that inflation by the total population. So simply if I say the total income by total population, that will give you the average income of a person, right? It serves as an indicator of the standard of living of a country. However, it may not be adequate measure of the welfare because it does not reflect the distribution of such income among the people. Now, what does he want to say? He says it shows the average income, but it doesn't show the distribution. This person is earning only 100 rupees and this is earning 10,000. When you will average it out, right, this person's income will increase. So we cannot say the distribution, that how this income is being distributed. If one person is earning 100, another one is earning 10,000, so how can you say the standard of living? How can you say it is an indicator of standard of living? So it is not an adequate measure of welfare, right? This is the person who is earning 10,000 rupees is comparatively in a better position than the person who is earning 100 rupees. But if you average out this income, then you may say that both the people are equal, sir. Both the people are earning good, isn't it? So that is why it is said that it is not an adequate measure of welfare. It does not reflect the distribution of such income among the different people. Okay. So this is per capita income. These can be asked in the small marks. For 2 marks, these can be asked, right? Now, the next is the personal income. Now, what is personal income? The personal income is a measure of actual current income receipts of the household sector from all the sources. I am a household sector. I am working in a factory, right? I am a labor who is working in the factory. I am earning from there. Personal income is whatever the income that I am earning as an individual, or the household sector. Household sector is the sector which is working for someone, right? Whatever the income that sector is generating, or whatever the money that sector is getting, whatever the money that sector is getting, that is personal income. Now try to understand very carefully. There are small points in this. He says personal income is the income actually paid out to household sector but not necessarily earned, right? I am getting some money. I'm getting some money, right, as a compensation from government. Have I earned it? No, sir. I have not earned it. What is earning? You are earning the money when you are working for that money. You haven't worked for that money, right? You got a compensation for any reason. For example, I have taken an example here. Ram lost his job during COVID, right? Now he has received 4,000 as unemployment compensation from the government. Has he worked for the government for that? No, sir. He's not working for the government. That is a sort of compensation being given by the government, that yes, okay, you are sitting at home, you have lost your job, so we are going to pay you 4,000 rupees so that you are able to carry out your routine activities, isn't it? Now, have Ram earned this? No, sir. Ram has not earned this, right? But he has received it. So any income, even if it is not earned, if you are receiving that, that will form the part of your personal income. The word here that is important to remember is actually paid out. This is the important part. We say what is actually paid out, right? Whatever the payment, actual payment you are doing. So he says this amount of 4,000 will form the part of his personal income, but not a part of national income. Now, this is not a part of national income. Why, sir? Why? Because if you remember at the very beginning, when we discussed about GDP at MP, there were some exclusions that we discussed. I'll show you. What are those exclusions that we discussed about? See, exclusions from GDP, and one part of it was transfer payments, or uh, yes, value of non-economic activities can be there, and this is a transfer payment. This is a transfer payment from government, right? And transfer payments are not included in the GDP at MP. And if it is not included in the GDP, how can it be included in the national income? Not possible, sir. Absolutely not possible, right? So national income says, in the national income, we consider only and only that income which is actually earned, right? Which is actually earned by manufacturing the goods or by providing the services or in any form. Clear? But when we are saying personal income, we say personal income is any income even if we have not earned it, right? Even if we have not earned it, if we are getting that income, it will be my personal income. Now, personal income forms the basis for the consumption expenditure. Sir, this 4,000 I get from the government as a compensation, right? Now, obviously, I will spend this 4,000 rupees or not. So this personal income shows the consumption capacity of a person, right? That is what is meant by this line, that personal income forms the basis of consumption expenditure. This personal income shows that how much a person can spend on the consumption. Because why it is important to understand that what the person can spend on consumption, because that will help in the money rotation, right? Today I have 4,000 rupees, I will spend that 4,000 rupees, then it is an income for someone, right? The goods will be used, then new goods will be manufactured, right? This circle will move on. We'll study about this circle also, don't worry, right? We have a full topic on that. So personal income forms the basis of consumption expenditure. So PI is national income. National income is what is household sector getting from the national income? Sir, what is being paid to factors of production, right? So national income plus income received not earned, like this 4,000 rupees compensation that the Ram has received, it is income received but not earned. But if there is any income that you have earned but you have not received it, that is to be subtracted from the personal income. So that means what is to be included in the personal income is what is actually you are getting in your pocket. If something you have earned, but you have not received, let's say you are one of the shareholders in a company, right? Now the company earns profits, but company doesn't distribute that profits, company retain that profit. Now you have earned that profit, you are a shareholder, you have the right to that profit, but you are not receiving the part of that profit, right? You are not receiving the part of that profit. So that is income earned but not received. Clear? Similarly, we can say the employer contribution to ESI PF. Now, what is that? Let's say your salary is 10,000 rupees. The employer says, I will pay you 9,000, 1,000 I will contribute to PF and ESI. Now, this 1,000 is your income. You have earned that, you have worked for that, but you are not receiving that income, right? So that is to be subtracted. So PI is only what is the amount, what is the income that you are actually getting in cash in your pocket, which you can spend. That is important. Okay. So what is income received but not earned? This includes the transfer payments such as social security benefits, unemployment compensation, welfare payments, already discussed. What is income earned but not received? Income earned but not received. This is the income earned by individuals but actually not received by them. Undistributed corporate profits, contribution of the employers to social security scheme, that is ESI and PF. ESI, PF and contribution to those things. Clear? Now, points to remember. National income is not simply the sum of personal income, as personal income includes transfer payments, whereas national income doesn't include. He says national income is simply not the sum total of personal income. Why? Because in the personal income, you are getting something beyond which is not included in the national income, as we have already discussed about the transfer payments, right? Also, not all the national income accrues to individual as their personal income. That is the income earned but not received by individuals. He says everything that you are earning as a national income, it doesn't mean that everything will flow to the individuals as their personal income, right? Something can be retained as the profits. Now it is not being distributed. Something can be contributed to ESI, PF. Now this is not their personal income, right? This is not the personal income of the individuals, right? So these are the important points to remember. This is about the personal income, and this will be used in the practical part. This will be used in the practical part, right? So we'll end this lecture here, right? I'm not going to extend it, otherwise you people will start getting bored, and I know after 30 minutes your graph going like this, okay? Until unless it's a live class. In the live class, obviously we can extend it up to 1 hour or 1.5 hours, as we have been doing in the costing batch. Okay, so what are the topics that we are left with? In the next lecture, what we are going to do is disposable personal income, national disposable income, private income, right? And then these three topics, then we will move on to the practical part. Okay, we will be covering the practical part also in the next lecture, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.